Welcome to this episode of CEO Perspectives, a signature podcast and webcast series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan view at a range of timely topics that matter most to business leaders. To help make sense of these topics and how they'll unfold, we'll sit down with thought leaders and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland, the CEO of the Conference Board and the host of this podcast series. And in today's conversation, we'll discuss a trend that has really ramped up in recent years and has made a lot of headlines: shareholder activism. It's all about driving change, and shareholders turn to it when they think that management isn't maximizing a company's potential. But what is shareholder activism? Is it good for the economy? How can boards prepare for it? Joining me today is Dr. Bernard Bailey, a leading voice on corporate governance issues. He currently serves on the boards of Telos and Argo Group and was the CEO of two separate publicly traded companies. He's been a public director for many companies for a long time, and he has a PhD in management and teaches at the Weatherhead School at Case Western University. Bernard is no stranger to the Conference Board. In addition to being a trustee for many years, at our Public Policy Center, the Committee for Economic Development, he was the president of CED. Bernard, welcome to the program.
Thank you, Steve. It's great to be back with the Conference Board.
So, Bernard, just briefly for our listeners, talk a little bit about your experience on boards.
Sure, Steve. My first experience as a director on a board started when I became the CEO of a publicly traded company, which, by the way, is not that unusual for CEOs. Very often it's the first time that they've ever become a board member. So that was my first experience. And quite honestly, somebody shared with me before I took that job, they said the only thing worse than being the CEO of a publicly traded company is being the CEO of a publicly traded company that still thinks it's a private company, which I didn't fully understand at the time, but I certainly learned as I went through that experience then. And out of it, it was during right around 2001, 2, 3, and 4, and through 2006. And out of that period, if you'll remember very well, that was when so much was going on in corporate governance. And we had the SAR box, which came out, which really put a lot more pressure on boards of directors and their responsibility. And so what really came out of that for me was kind of an eye-opener that really said, if we're going to protect capitalism in this country, we've got to do a better job at the board level. And it kind of piqued my interest and led me to go get my doctorate in board governance, where I really focused on boards and how they make more effective decisions in the marketplace and for their companies. And since that time, I've been on 9 publicly traded companies. 3 of them, by the way, when I went on those boards, I went on as either part of the slate of an activist shareholder or either as a nominee that was negotiated as a board member going on the board. I've also sat on 3 different private equity-backed company boards, including the Carlyle Company, and that gives me a very different perspective. And then in addition to that, I've been on 4 not-for-profit organizations, including serving as chairman of a large conservation organization here in the United States. So I've basically have served as the chair of a few publicly traded companies. I've been the chair of all of the standing committees within a board and served on all of the boards. So I've had kind of a unique perspective. Not only have I gone onto a board as part of the activist slate, but in addition to that, I've been on boards when activists have come and confronted those boards. And so I've had that kind of experience also. So I'm excited to talk about activism and what it really means today as we move forward in building corporate America.
Wow, your experience is really second to none in this whole area. Most companies live in fear of activism, and if you read the business papers, you're always seeing some activists going in and attacking a company, and you get stuff in the mail about this and that. But talk in general. You've been part of the group that's gone in as an activist. What is an activist shareholder, and what role do they play in the market today?
Yeah, well, an activist shareholder, very, very simply, to think about it, is anybody who takes an equity investment in a company for the purpose of driving change within that organization is an activist shareholder, is an activist investor. All right. So to understand that, you have to kind of look at the full spectrum of what activism really means. And I like to think about it as you really have three primary types of activists. The first are those shareholders who take a de minimis stake in a company, and they do it with the express purpose of having environmental and social change occur in that company. And, you there at the conference board just recently put out a paper, as we're in proxy season here. And these are often issues around social activists, environmental groups, organizations like As You Sow, Greenpeace, as well as individuals. They have a specific social or environmental issue that they want the company to address in some way. They want shareholders to vote on that and show the importance of it to the company. So right now, there are over 500 of these solicitations for shareholder votes in this proxy season, and we'll see how they pan out. Most of them are around areas of environment. The climate is getting a tremendous amount of attention, how companies are addressing climate change. The workplace, political influence with the polarization of our country, then, how companies play in terms of making donations, doing lobbying, and so forth on political issues is also having a big influence. So I'd really, in that area, ask anybody who's more interested to really go to the conference board's paper on that. I think it's a very comprehensive and outstanding report that really outlines the issues here for 2022 as we go into proxy season. That's
and that's okay. That's what that I was going to say. That's one whole classification, and that's and you know what, that it's a different kind of a look than in the past. That's the E and the S part of ESG, environmental, social, and governance. And I'm sure you're going to talk about the governance side.
Right. So then you have a second category of activist issues, right? And activist players. And what you typically see here these are the ones that want to deal with the governance issues. And they're primarily driven by the large pension funds, the New York State Retirement Fund, CalPERS, TIAA, and their focus is really around dealing with shareholder access. All right. In other words, is there a governance sin that exists in your company? And if it does, we expect to see it corrected. Their fundamental premise is that good governance results in good performance in corporations. Now, understand from their perspective is that these are usually passive funds, meaning they're not actively able to trade in and out of the company. So if they want to see a change occur, they often will go at it in trying to get the governance fixed within a company that they're invested in. So they're going to be looking for things like, do you have a staggered board? All right. Do you have CEO duality, meaning your CEO is also the chairman? And do you have a lead independent director, if that's the situation? Do you have compensation practices that are consistent with what they feel is creating value? In fact, compensation is often an interesting one because very often they will look at compensation practices as a real window into the independence of that board relative to the CEO. And of course, now the big one is board diversity. And so that's a unique area. And I would argue that that is one side of a coin. The second side of that coin is this third area of activism, which is the one that we opened our discussion about today, which really is about shareholder value creation. And this is driven primarily by the hedge funds. And in the case of environmental and social, you'll typically see, as I said, over 500 of these shareholder proposals. But in the case of the hedge fund involvement, we're seeing a big uptick. We went through the pandemic and we were seeing pre-pandemic maybe 100 or 110 of active engagements. That dropped down during the pandemic to about 80 to 90. But now this season, we're seeing it kick back up to about 120 engagements. These are the ones that get the most publicity. They have the names that we hear in the business news all the time: the Carl Icahns, the Loebs, the Ackmans, Starboard Capital, etc. But there's also a growing number of mid-size and small-size hedge funds that are really getting less attention, but are really focusing on the small and mid-cap marketplace. So the point being is that it used to be that a lot of companies were shielded away from a lot of this activity, but it's taking on more and more prominence across and permeating across all of it. And what they're looking very simply for is to drive improved shareholder value.
Yeah, and so it seems like this has morphed over the past 40 years. Back in the 80s, it seemed like it was mostly the last category, barbarians at the gate, companies that had not produced enough shareholder value, conglomerates that they thought should be broken up and create value. And then it became more of the governance side, which is, you've got to get your bylaws together and your practices together that are consistent with norms. And then now it's most recently the E and the S side. Is that a fair description of the evolution?
Yeah, no, I think you've captured it really well, Steve. The way I like to think about it is, what we're dealing with here is a power struggle. Okay, if we go back to the 70s, there was a lot discussed at that point about the imperial CEO, the CEO who put his buddies on the board from his country club. And I say his because, let's be honest, it was almost all male back then, and boards were almost completely all male. And so they put their buddies on the board. The boards were acquiescent to whatever the CEO really wanted to do. The CEO was the most revered position in America at that time, and they could do no harm. They could do no wrong, with the fact that the corporations were growing post World War II. However, then the problems started to occur through globalization and a whole lot of issues, and it became a power struggle between the board now in management. And it was really about wrestling power away from the CEO and giving more power to the board over the CEO. We went through that period through the 80s and 70s. And since that time, especially as we got into 2000, the power is shifting. Now, I say that because our governance system in this country is a Republican governance system. Not in the party sense, but in the sense of republic. Shareholders, who are the owners of the corporation, they elect representatives. That's the board of directors. And the board of directors then is given all the authority to make the decisions to run the corporation. But what's been happening is a major shift now to take more and more power away from boards and give more to the shareholders. So when you see a lot of these actions from a governance standpoint, it's about trying to wrestle control and power away from boards to give shareholders more control. That's why you see the pension funds playing so much more of an important role there. And as a result of that, a lot of the actions that are being taken are just that. So when you start to see these activists come in now, what they're saying is, hey, this Republican system isn't working. You as boards of directors aren't listening to what's important to us as the owners, and therefore we're going to wrestle control away from you and take more of that power in our hands to affect the change that we want to see happen on the corporation.
Right. Now, is it my imagination, or has this kind of also evolved from activism towards the largest cap companies, large companies, large capitalization, but it seems now that to be more focused at mid and small cap companies. Is that fair?
Oh, I would say, Steve, that I don't know that it's more focused at mid and small cap. I think what you've seen happen was that if we go back to the 80s and 90s, a big piece that was playing then was the junk bond market. It put a lot of capital out there that allowed a lot of money to go in and circulate and start to play in taking control of corporations. All right. Now, what you've seen is that there's still a lot of play at the large corporations. In fact, hopefully we'll talk a little bit about Exxon, right? And I think maybe I'll just stop right now and mention Exxon, all right? Because I think it's a fascinating case study for people who really don't understand activist investment to understand that. So here's a relatively small hedge fund, engine number one, out of New York City. They took a 0.02% share of Exxon. So they own 0.02% of the Exxon Corporation. And in doing that, they basically said that you as a corporation are not moving fast enough to evolve your company away from being a carbon-based energy company to a company that is less carbon-based. And so they advocated to put 3 members on that board of directors. Now, you sit there and you say, how in the world could somebody who only owns 0.02% of a company affect that level of change in a shareholder election? Well, the fact is that they were able to demonstrate that this change was needed in the company. And in doing that, then they garnered the support of 3 of the largest investment funds in this country: BlackRock, State Street, and Vanguard, who own 30% of the ownership of the stock of Exxon. And with their support, as well as proxy services support, who play a really important role today, ISS and Glass Lewis, all right, they were able to win those 3 seats on the board and put their activist board members on there to be able to drive the change in the company. So that's at a very large level. But so what we're seeing now is the advent of smaller hedge funds who don't have the capital to go in and the influence to do that, but they can go in, take a 3, 4, 5, 7% position in, let's say, a $2 billion market cap company and make the same kind of change occur and realize the same type of returns for their investors and their hedge funds. So we're just seeing a lot more activity occurring now.
Yeah, a lot of fragmentation on both sides and a lot of activity. We're going to take a short break. We've talked about activists and what they're hoping to achieve. Next, we're going to explore the pros and cons of shareholder activism and what boards and management should do about it. I'll be right back with my conversation about activism.
As you and your company monitor the latest wave of shocks that have battered the U.S. economy, the award-winning forecast team at the Conference Board now predicts a U.S. recession by the end of 2022. This recession will further compound the crises that have recently upended expectations, from a deadly pandemic to a war in Ukraine and the highest inflation rate in decades. Yet, unprecedented crises also present unforeseen opportunities if you have a trusted, proven navigator by your side. With that in mind, the Conference Board continues its long-standing tradition of providing timely and relevant content on a daily basis to help guide the business community through the economic storm. These trusted insights are being gathered on our website and are available to help your company master the challenges ahead. Chart a course for the future, which will allow your business to emerge stronger on the other side by visiting our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at www.conference-board.org/topics/recession.
Welcome back to CEO Perspectives. I'm your host, Steve Odland, the CEO of the Conference Board, and I'm joined by Dr. Bernard Bailey, former president of the Committee for Economic Development, which is the public policy center of the Conference Board, and of course, shareholder governance expert extraordinaire. Well, so Bernard, there are pros and cons to the whole subject of activism. There certainly are some good things that happen out of it, but there are also some negative things. Talk about, both sides of it.
Sure. I'll tell you, it is an activity in governance that is really very polarizing and dividing. I think on the positive side, what you see is that The problem we have is an age-old problem. It was identified by Adam Smith and his Wealth of Nations. It was really amplified by Burl and Means and their seminal book on the modern corporation in the 1930s. And that was the agent principle or the agency problem in a corporation. When you split ownership from management, how can you be confident that management is going to act in the best interest of those absentee owners? Right? So there are three ways you do that. One is you do it with independent and engaged boards who really have the oversight and look out for the interests of the shareholders. The second way you do it is by aligning the incentives of the management team with the shareholders. We've tried that over and over again with CEO compensation. Nobody ever seems to get really happy with it. All right. The third way, though, you do it through a market check. And that's really where activism plays a role. So they play a very, very important market check. And it's a very positive role that they play to keep boards of directors and management in place. In addition to that, the other difference is that if you look at these hedge funds, before they launch an activist campaign, very often they have followed this company for 2 or 3 years, and they understand it deeply. They've gone into a very deep analysis of it, and they have a very fresh view. Let's be honest, there are some boards that become very stagnant. They become oversituated in the company. And in fact, many would argue they're no longer independent. And so these hedge funds can bring a very fresh view with deep analysis about things that need to be done in that company. And then thirdly, that results in a reawakening of the board and management to deal with a sense of urgency that maybe they didn't have before. So lots of pros from that perspective. Now, having sat on the other side, when an activist comes in, there's some cons. The first one is it's a tremendous distraction to management and the board, right? And there are certain things that that are going on as a board member and as the management team that you haven't disclosed yet. You're not able to disclose. So as an outside investor, the hedge fund may not be aware of those things. So it becomes a distraction to your strategy. It's also very expensive. Right? Once you get into one of these, they go very quickly. They're very expensive. You bring in lots of advisors, and it really distracts you in the process and costs a lot of money. The other concern is, just like you have good CEOs and bad CEOs, good boards and bad boards, good directors and bad directors, you have good activists and bad activists. And some of these bad activists, they don't act in the best interests of the corporation. They'll act in their own self-interest. And very often that has been described as they're looking for a short-term bump in the stock and will then very often peel out of that stock very quickly, leaving the long-term investors in there. So there's this whole argument about short-termism and the implications that has on them. So then you ask yourself, well, is it good or bad? Is activism good or bad? And as I said, if you have good activism, I think it works very, very effective as a check in the marketplace, because not all boards and all management teams are doing the best that they can do. On the other side of the coin, when you have bad activism, it can really be very disruptive and destructive to the economy and to corporations in general. Now, then we turn to, let's have a fact-based discussion on it. And the reality is there have been a couple of seminal papers that have been written out of Duke University as well as the Harvard Law Center. And in one seminal piece of work by Lucian Bebchuk out of Harvard, they looked at 2,000 instances of activism over a 14-year period. They examined those companies 3 years prior, and then they held on and looked at those companies for 5 years after activism had occurred. And what they found is, on average, that there was an increase of about 7.5% performance above their industry group for those companies that had activism occur on it. So it isn't just a short-term phenomenon, but it really, that activism provides longer-term value in the company based upon the studies that have been done from a academic perspective.
Yeah. So, some of the early work, as we discussed, was focused more on shareholder value creation. In other words, how do you get the stock to move? And then later into governance. But the whole notion of shareholder centricity also has evolved in society, and it's corporations now are focused on multi-stakeholders: customers, employees, owners, environment, community. And I think this is what has led to the rise in the E and the S, as you've pointed out, the kind of activism, environmental and social activism. So out of the multi-stakeholder in this multi-stakeholder world, what are these additional risks? It's not just that companies, the management and the board need to provide shareholder value, but they also need to be great citizens now.
Well, you're right about that. You and I have discussed this quite a bit, and
yeah.
I guess, Steve, I have always argued that corporations have always been interested in being great citizens. Okay, I think the really well done corporations, I don't know of any corporation that didn't look at their company and say, gee, I'm trying to build the best company I can. And that means I have to take care of my customers. I have to take care of my employees. I have to take care of my community. And I have to also make sure there's something there for the investors here, right? I often remind people, my students in particular, when I talk about this, what does it mean to be a shareholder? A shareholder, what it gives you is a claim on the residuals. In other words, it's a claim on whatever is left over after you've paid everybody else. So they get the scraps that are left over at the end of the table, after employees, after executives, after the community, after R&D, after taxes, everything. So the focus there is somebody has to look out for that to make sure that occurs. That being said, when you don't run the company in the best interest of the corporation, which is what boards are expected to do, they're not expected to do just what's best only for a shareholder, but rather the entire corporation, then you have an impact. So if you as a board allow yourselves to get bullied into taking actions that are not in the best interest of the corporation, then it starts to hurt a lot of people. So take an example, right? A big push has been to take a lot of cash, particularly from technology companies, but other companies, and redistribute it back to shareholders, either in the form of dividends or share buybacks. In some cases, companies then go and leverage up with debt. Well, that's cash that's not available to put into investing in your employees, investing in your community. It puts more risk in the company from a debt perspective. All of that then can detract from the long-term investments that you want to make in your employees, in your products that benefit the corporation in total, and certainly customers, employees, and the community. So all of that is important. And when that happens, everybody loses out. And what can happen is an activist investor then can benefit on this short-term bump in the stock, move out of the company, and leave people there. I also remind people that when you look at this, who's most invested in a company? The most fungible asset is capital. It can move from company to company in a matter of milliseconds. All right. Employees, they become deeply invested in a company. And so that investment needs to be considered as we look through, what are the right decisions that need to be made by the board.
So just to wrap up then, it sounds to me like what you're saying is that multi-stakeholder, balance all of it, do the right thing. I mean, everything we learned in kindergarten, essentially, and the
Right.
boards and management teams need to be thinking about this from all these aspects and bake that into their strategy.
Yeah, I mean, that's absolutely right, Steve. So, I mean, when you think about it, if let's back up to the beginning here, right? Why does an activist investor get involved, a hedge fund get involved in your company? All right. Typically, there are two things going on. One is that company is performing below and often significantly below its peer group from a share price standpoint. So you're not getting the return on assets, you're not getting the return on capital, you're not seeing the return on equity occur in that company. All right. Secondly, very often there's a governance failure that's going on in that company. The board's not taking action. The board may not be as independent as it has been in the past. It may not be holding management accountable. It may not be doing the things that it needs to be doing. Those two things are absolutely critical to a corporation that it has to do. And then along that line, then corporations need to have a strategy in place that says, this is how we're going to create value for the shareholders, but also value for employees, our customers, and as well as our community, and do it in a way that's ethical and legal in that environment, right? And you put all those things together, then your company should perform well, and you don't have to worry about activists engaging with you. So the activists typically come in when those things are not going well within a company.
Yeah. Bernard, this was a great discussion, and we really appreciate your insights.
Well, thank you, Steve. It was a pleasure speaking with you today, and always a pleasure working with the conference board. Thank you.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by a prominent thought leader to provide insights onto the issues of our time. We'll cover leading topics in economics, geopolitics, public policy, ESG, human capital, and more. Please share CEO Perspectives with all of your colleagues, your friends, your neighbors, your family. I know they'll want to listen. I'm Steve Odland, and this series has been brought to you by the Conference Board.